All right, NTA, so we're going to teach you guys how to overcome the 4 scenarios you're going to see at the kitchen table. The first one we will start with if they own nothing at all, not even through their job. And that is right there on the page for you in the packet we give you. And again, in the before and after presentation, right after the debt, we show them life insurance. But the first question we ask is, after the debt, Anna, do you own any types of life insurance outside of work?
No, I don't own any life insurance.
You don't own any life insurance, really?
Right.
Not even through your job?
No.
Oh, wow. Okay. So usually, Anna, when I sit down with a responsible family like yours and they don't own any life insurance outside of work, that's usually due to one of 3 reasons. Most families I sit with will say, Ryan, I know it's important, I just never got around to it. Some families think they can't afford it, and then some families, I know this is not you, Anna, but believe it or not, I still come across some people, they just don't care about their family. So of the first 2, which would you say is why you don't have any protection right now?
Well, I see value in it. I just never got around to it.
Never got around to it. Okay, gotcha. So here's a question I always ask, Anna. What's the biggest asset that you own? Like, what do you own that's worth the most money that you could sell? What do you own that you could sell that's worth the most money? What would you say that is?
My house.
Your home. Most people say their home, right? Their home or their car, right?
Right.
Now, to pay for a home, you have to have money. True?
True.
How do you make money?
I have to go to work.
You got to go to work. Who has to go to work?
I do.
Exactly. So, Anna, what's a bigger asset, your home or your ability to make money?
My ability.
You're exactly right. So, Anna, if that's the biggest asset you have, doesn't it make sense you protect it?
Absolutely.
Now, can you see why life insurance is so important?
Yeah.
I mean, you believe in providing for your family while you're alive, don't you?
Right.
So if you die prematurely, would that responsibility change, or would you still want to provide for them?
I still want to provide for them.
Exactly. Because right now, and if we took you out of the equation, God forbid you did die prematurely, and your income disappeared, would your kids' quality of life get better or probably get worse?
Oh, worse.
And you wouldn't want them to struggle, would you?
No.
Exactly. So Anna, let me show you the 2 types of insurance that you can own.
Okay.
And I'm in the presentation. Good. Oh, keep going? Oh, not bringing it up? Okay, we'll keep going. All right, next one. They might own life insurance just through their job. So they have no life insurance, but they have it through their job. Same thing before and after. Anna, do you own any types of life insurance outside of work?
No.
Really?
Yeah.
You don't have any life insurance outside of work?
Not outside.
Oh, wow. Okay. Have you ever considered it before, Anna? Do you know the importance of having your own policy outside of work?
No, not really. I think
Okay.
I have a good one at
Sure.
my job.
Okay. Well, Anna, there's 4 reasons you should have your own policy outside of work and why you should never just rely on group insurance. You mind if I share them with you?
Sure.
So number 1, Anna, if you ever left your job, what would happen to your life insurance?
Oh, it'll probably be gone too.
Exactly, because you don't own it. Number 2, Anna, how much coverage do they give you through your job?
I have no idea. I think not that much, like maybe 10 grand or something.
10 grand? Okay.
Yeah.
Well, Anna, let me ask you this. God forbid if you died prematurely, how long would 10 grand last your 2 kids?
Not long.
Not long. So, Anna, would you agree you need more than that? Exactly. Number 3, Anna, how much do you pay for it, if anything? How much do you pay for it?
I don't know. It just comes out of my check.
Is it like too little to notice?
Yeah.
Okay, like more than $5, less than $5 a month?
Probably that.
Yeah, okay.
Yeah.
Which is pretty cheap, yeah?
Yeah, it's cheap.
You ever wonder why it's so cheap?
No.
So put yourself in the shoes of the insurance company, Anna, and I'm one of the employees, and I pay you $1 or $2 a month, and I die. Would you really want to pay out $10,000?
No.
Can you see why it's so cheap?
Yeah.
Now, I'm not saying your company wouldn't pay out, Anna, but I've seen companies take up to 2 years just to pay out $10,000.
Oh, really?
Yeah. Now, the 4th and most important reason, Anna, is you don't buy life insurance. You have to medically qualify for it. Did you know that?
No.
Yes, they base it off your age and your health. So you'd agree you're the youngest you're going to be right now, right?
Yeah.
So every day that goes by, you get older and older. And as you get older and older, the cost goes up and up. Not only that, but your health changes, right?
Yeah.
So what if we wake up one day and develop an illness like cancer, diabetes, or an illness like that, and then you want to qualify for your own policy? Do you think any company is going to want to insure you then?
No.
No. So, Anna, wouldn't it make sense to qualify for something now when you're young and you're healthy versus waiting?
Yes.
Yeah. Now, can you see the importance of having your own policy outside of work?
Yeah.
Okay. Perfect. Well, there's only 2 types you can own. So when you get your own policy, Anna, and that's that. All right. 3rd scenario. They could own a whole life policy. So Anna, the next thing we did is we looked at their life insurance. Do you own any types of life insurance outside of work?
Yes, I do. Actually.
You do?
Yeah.
Great, that's fantastic. What kind of policy do you have? Is it a term or whole life?
I don't know. There's some savings in there or something like that. I'm not quite sure what it's called.
There's like a cash value savings, is that what you're referring to? So it's a whole life policy?
Yeah, I think so, yeah.
Okay, gotcha. What company do you have it with, do you know?
I think it's Prudential.
Prudential? Okay.
Yes.
When did you buy the Prudential policy, do you recall?
Maybe like a year or 2 years ago.
Just a couple years ago.
Yeah.
Fantastic. And what's your relationship with the agent who sold it to you? Are you guys like family members or friends or anything like that?
Oh, no.
No.
He's just some guy.
Gotcha, okay.
Yeah.
And why did you buy the whole life policy? Was it for the insurance, the savings, or both?
I would say probably both.
Both? Okay, fantastic. Well, Anna, let me show you this before and after example. So you can see Bob and Susan, they have what you have. It's called a cash value or whole life insurance policy. All right.
Okay.
So they're both insured for $150,000. There's no coverage in the kids, and they're paying $300 a month. Now the first problem is they have $250,000 of debt, right?
Right.
So if one of them dies, is that enough to pay off the debt?
Nope.
No, they need more, Anna, but they can't afford more because it's $300 a month. It's just too expensive. The reason it's expensive is they're paying for two things in one. They're paying for life insurance with a savings account combined. All right, the savings account is called cash value, and at 67, they'll have $124,000 saved. Now, it sounds good, but the catch is this, Anna. If Bob or Susan dies, they don't get the insurance and the savings. They get the greater of the two.
Okay.
So even though they've built up $124,000 of their cash value, if Bob died, they'll pay Susan $150,000, but the company keeps the cash value for their own profit.
Wow.
Yeah, so imagine that, Anna, you pay for two things your whole life, and when you die, your family got one of the two. What would you call that?
A rip-off.
Exactly. So, Anna, I don't know if that's how your policy works now, but I've been replacing whole life policies for 10 years now, and that's how they work. So, Anna, if you lost your savings when you died, how'd that make you feel?
Oh, mad.
Very mad, I agree.
Yeah.
So what we did is we got them a term insurance policy. So with term insurance, we gave them $400,000 versus $150,000. The kids had no coverage here. We covered them for $25,000, and we lowered their cost from $300 to $100 a month. So we just doubled their insurance for 3 times less. How do we do that? We keep your insurance and savings separate. See, when you buy term insurance, you get more coverage at a lower cost because you're just buying insurance. There's no savings with it. With the $197 a month we save them, we invest the difference in a mutual fund. So we keep the savings and insurance separate. That way, if you die, Anna, your family gets to keep both, whereas here they get one or the other.
Okay.
Does that make sense?
Yeah, it makes sense.
So now, after seeing that side by side, Anna, which would you rather own? The cash value, or the term insurance?
Definitely the term.
It's a no-brainer, right? Well,
Yeah.
Anna, let me ask you this: if we could show you how to get the same coverage or more coverage at a better cost and a better value, I'm assuming you'd be open to a second opinion, wouldn't you?
Oh, yeah.
Great. And then you finish the presentation, you finish the money compensation, you ask the question, what would interest her more, the financial game plan or both, right? And then my transition is this. Well, great, Anna. So before we go further with how to do the financial game plan, how to get started with this, let me explain to you how your whole life insurance policy works, all right?
Okay.
All right, Anna, so here's how whole life insurance works, all right? Can you, lift it up? Hold it, so it's vertical. All right, so Anna, here's how your whole life insurance policy works. Let's say for easy numbers, you're paying $100 a month, okay? Your premium goes to 2 separate things. It goes to insurance, and it goes to what's called a cash value savings, all right? So let's say you have $100,000 of life insurance. The problem lies in the cash value. There's 4 rules inside of this policy that the agent never discloses. So rule number 1, Anna, is in years 1 through 4, you have no money saved. So all of the premiums you give to your company, it goes to fees and commissions for the agent. So imagine going to your local bank and open up a savings account, and your banker says, "Welcome, Anna. We're very excited for you to open up a savings account with us. I just want you to know all the money you deposit in the first 4 years, we're going to take out of the bank and we're going to pocket it for our own benefit." Anna, would you open up a savings account with that bank?
No.
Of course not, but you just did by buying that whole life policy. The second rule, Anna, is after year 4, the company will give you a 2 to 5% return on your money. Now, inflation alone is 3%. So is 2 to 5 really that good of a return?
No.
Not really. It's a very poor savings. The third rule, Anna, if you ever need to take money out of your savings, so let's say the kid needs braces, the tire goes out, you lose your job. If you ever need to take money out of your cash value, you have to pay it back to the insurance company at 4 to 8%. Not to yourself, you pay it back to the company. Does that make any sense that you should have to borrow your own money?
No.
Of course not. And here's the fourth and final rule, Anna. If you die, you lose the cash value.
Okay.
So let's say you put money in this policy for 30 or 40 years and you save up $70,000, let's call it, and you died. You'd want your family to get the $100,000 and the $70,000, wouldn't you?
Yeah.
That's not the way it works. They pay your family the insurance, but they keep your cash value. Now you might say, well, I paid for $100,000 of insurance, that's what my family gets. What's wrong with that? Well, not really, because keep in mind, they kept $70,000 of your cash value. So, and 100 minus 70 is how much?
30,000.
So you're really only paying for 30,000 of life insurance.
Really?
So can you see how you do not want to own that, Anna?
Yeah.
Well, if I could show you those rules in your policy, would you take a quick minute and just go and grab it for me?
Yes.
Awesome. By the way, where's your nearest restroom? May I use your restroom real quick?
Yeah, it's
Okay.
over there.
Okay, great. That's whole life. All right. Now let me go over term. Might need another piece of paper for term. If they own term. Same presentation, guys. So the next thing we did, Anna, is we looked at their life insurance. Anna, do you own any types of life insurance outside of work?
Yes, I do.
Oh, you do? That's fantastic. Awesome. Is it a whole life or is it a term policy?
I think it was a term.
Is it a term?
Yeah.
Okay, great. Awesome. And what company do you have your term policy with?
I think it's Allstate or something like
Allstate?
that.
Okay. What's your relationship with the agent? Is it a family member or a friend?
No.
No? Okay. And tell me, how long of a term did you purchase?
I think it's like maybe 10 years.
10-year term? Okay.
Yeah.
And when did you get it? How many years ago?
2 years ago.
2 years
I think.
ago.
Yeah.
So you have about maybe 8 years left. Does that sound about right?
Yeah,
Okay.
yeah.
Awesome. Great. Well, Anna, there's 2 types of insurance you can own. Bob and Susan own what's called cash value or whole life. So you can see Bob and Susan are insured for $150,000. There's no coverage in the children, and they're paying $300 a month. Now the problem is they have $250,000 of debt, don't they? So if one of them dies, they don't have enough, right?
Right.
Now they buy more, but it's too expensive. It's $300 a month.
Okay.
The reason it's expensive is they're paying for 2 things in one. They're paying for insurance and savings combined. All right. The savings account is called cash value, and
Okay.
it's $67. They'll have $124,000 saved. Now the problem is the agent never tells them, but the contract says if Bob or Susan dies, they don't get the insurance and the savings. They get the greater of the 2. So Anna, even though they saved $124,000, if Bob died, they'll give Susan the insurance, but the company keeps the cash value for their own profit.
Wow.
Yeah, you imagine that, and you pay for 2 things your entire life, and when you die, your family got one of the 2. What would you call something like that?
A rip-off.
You're exactly right. It's a legal rip-off. So, and you're going to be a huge advocate of what we believe in because all we offer is term insurance. With term, we gave them $400,000 versus $150,000. The kids said no coverage here. We cover them for $25,000, and we lower their cost from $300 to $100 a month. So we just doubled their insurance for 3 times less. How do we do that? We keep the insurance and savings separate.
Okay.
So when you buy term, you get more coverage at a lower cost because you're just buying life insurance.
Right.
Now with the $197 a month we save them, we invest the difference in a mutual fund. So by keeping the 2 separate, and if you die, your family would get both of them.
Okay.
Here you get one or the other. You with me?
Yes.
So not to insult your intelligence, Anna, obviously you own term, but which would you rather have, the cash value or the term insurance?
Yeah, the term. That's why I didn't get the cash value.
Yeah, absolutely. Now let me ask you this, Anna. Did you know not all terms are created equal?
No.
Yeah, so here's what I mean by that. So Anna, you said you had a 10-year term, and you bought it 2 years ago, so you have about 8 years left. Does that sound about right? Okay. Well, I know you did tell me that you just purchased this home about, just a year ago? Is that right?
Yeah.
And you have 2 kids. How old is your youngest?
2.
2 years old. Okay, so you got a 2-year-old, and you got about 28, 29 years left in your mortgage. Anna, do you feel like you need life insurance longer than 8 years?
Oh, probably.
To at least cover the mortgage and your son, right?
Okay, yeah.
So, Anna, do you know what happens to your term policy after the 8 years is up?
I think it just ends, right? And I can buy another one, or
It does end. May I show you the three options you have in your term policy? So here's the 3 options, Anna. All right. So number 1 option, Anna, the first option is you can renew it. What does renew mean? That means you can renew the same coverage at a different price. So you're a lot older now, Anna. You're 8 years old. The cost is going to go up. The challenge is the cost will go up anywhere from 8 to 20 times the original amount. And it will basically go up every year after that and become an annual renewable term. Anna, does that sound attractive?
no?
No. Your second option, Anna, is what's called a conversion option. Conversion means you can convert it into a different kind of policy. Now, the only challenge is, Anna, the company's only going to allow you to convert to whole life insurance. And Anna, that's the one where you lose the savings when you die. You remember that?
Mm-hmm.
And what did you call that?
A ripoff.
Exactly. So far, Anna, you have option bad and you have option worse. If you don't like option bad or option worse, your third option is you could do a whole nother health test and have to re-qualify for a new term. Now, 8 years from now, God didn't make our body to get healthier and healthier, did He?
No.
So we may not be in the same health condition we are now, and you may not even qualify. So that is option impossible. So your 3 options, Anna, are option bad, option worse, and option impossible. Can you see how that's a problem?
Yes.
Exactly. So, Anna, if I could show you how to get a longer term, right, that could potentially save you money in the future, I'm assuming you'd be open to a second opinion, wouldn't you?
Absolutely.
Okay, great. Then you finish the remainder of the presentation. You go through comp, all right? You ask her what would interest her more, and you just say, well, great, Anna. Before we cover the rest of the game plan, do me a favor. Why don't you go grab that term policy, and I'll show you exactly how it works, okay? May I use your restroom?
Yeah.
Okay, great. There you have it. Those are the 4 scenarios. Get good at that, and you will become a pro